the banks and the people who give the money also know that. So they're not making ARMs like all that. You're not really saving that much by doing an ARM, and your upside versus downside, it probably makes sense to go fixed right now. But something to consider.
And the benefit to an FHA loan is that typically the restrictions on income as well as
All right, Anthony Mizplon. We're doing mortgages.
all the different types.
All the different types. So hit me. What's number one?
First, we're going to start off with the fixed rate mortgages, or FRM for short.
FRM. I've actually never even knew that was a real estate acronym for fixed rate mortgages, but we're all learning here. That's why it's an educational video.
Something new every
Yeah.
day.
Okay. So FRMs, fixed rate mortgage. What does that mean?
Essentially, your rate is locked in for the entire term of the mortgage, and those are usually set at 15, 20, or 30 years.
Yeah, I would agree. That's most common. What's the next one?
The next one would be an ARM, or an adjustable rate mortgage.
I've heard of an ARM before. Okay, so adjustable rate mortgage means what?
Essentially, that in the beginning, you're going to have a fixed rate, you're going to have a certain payment, but over time, that rate can change based on a certain index that's provided within the market.
Yeah, and usually those are fixed for like a 3, 5, or 7 year ARM, meaning it's fixed for 3, 5, 7. And what people don't quite understand about an ARM, they remember like the financial crash where it was subprime ARMs, and right? So an ARM actually can be a really great vehicle for somebody depending on the situation. I think ARMs right now, they're not priced that great, but in theory, ARMs right now would be fantastic because we're up around 7% interest, right? So if you're on an adjustable rate, my anticipation is 3, 5, 7 from now, most likely we're not going to be around 7%. If you look at historical norms, it should come down. So you could adjust down potentially, right? So, but the banks and the people who give the money also know that. So they're not making ARMs like all that. You're not really saving that much by doing an ARM, and your upside versus downside, it probably makes sense to go fixed right now, but something to consider. The thing about ARMs that I think people don't appreciate is they actually have set amounts that they can either go up or down per year. It's not like you can go from a 7 to a 12 overnight. That's not the way it works. So anyways, 2 cents on ARMs. What's the next one?
There's also interest-only mortgages, where essentially for, again, a short period of time, you're only paying on the interest. So yes, are those payments very low and the opportunity to cash flow is much stronger up front? Yes, but the downside to that is that entire beginning phase that you're making those payments, you're not building any equity, you're not paying off.
Yeah, and where I see a lot of interest-only loans making sense is like in investment situations.
Correct.
Right? So usually it's your community lenders, your portfolio lenders, your regional lenders. Those are the people typically doing interest-only. You're not going to call usually a big box unless you're like a high net worth person where they have special products for you. Big box lenders typically don't do interest-only, but they certainly exist, right? What's the next one?
FHA loans, essentially federally backed loans for lower to middle income families.
Yeah.
And the benefit to an FHA loan is that typically the restrictions on income as well as credit score are going to be a little bit more limiting, as well as the opportunity for a lower upfront down payment, as low as up to 3%.
Yeah, so FHA loans have a whole different set of rules to them than conventional or VA, right?
Correct.
And they're targeting the people that may have credit issues or just weird stuff going on. And the federal government gives them a vehicle to still get into the home. FHA loans usually get a little break on interest rate, which is nice.
Yeah.
Because the banks take a less risk, right?
Yes. And they're also protecting you as the buyer by being a little bit more stringent on the appraisal process. So if there were any items that might come up that need repairing, that would need to be done or negotiated prior to the closing. So you're protecting the buyer from being in a negative.
Yeah, structural safety, those
Correct.
sort of things.
Yes.
VA is actually the best product to accept.
I would agree 100%.
Yeah.